The Doc's new investment option.
Lead bullion.
Buy your ammunition from the Doc today at sdbullion.com.
The January 2014 Silver Shield collection is now available at sdbullion.com. 3 new coins join the series, including new strikes and sizes. First, the New Year's coin will mark the end of the Silver Bullet Silver Shield series and the beginning of the new Silver Shield series. Then, the new bullion strike, Bitcoin, graphically shows if you don't hold it, you don't own it. Finally, the new half-ounce Jesus shekel is a bullion strike that tells the story of how Jesus Christ was sold out for 15 ounces of silver by Judas. View the new January 2014 Silver Shield collection at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals Wrap. Joining us once again, it's been a while, Harvey Organ of Harvey Organ's blog spot and the Gold and Silver Report. Thanks for joining us today, Harvey.
Oh, it's a pleasure joining you guys.
Well, we had a big takedown today on Thursday in the precious metal markets, both gold and silver being sent down below support, gold breaking 1250, touching the 1230s before closing in the low 1240s, and silver actually dipping into the 18s before recovering into the low 19s. Access market closed this afternoon around 1915.
Right.
Ahead of the first notice day tomorrow, and again, in my mind, just a classic takedown the day after an FOMC statement. We've seen it time and time again over the last 2 or 3 years, guys, where day after Bernanke speaks and the Fed releases their FOMC statement is really the worst of the carnage, where the metals are taken down on the London market and early COMEX session on the Thursday, the day after the FOMC meeting.
Yes. Well, you also got to take into account, guys, that tomorrow is your first day notice on the gold contract. And traditionally, for the last 4 years that I can count, the day before first day notice is always waxed. And why? Simply because the bankers do not want holders of options being exercised for a gold contract. And if they knock the price down so it's below their purchase price, maybe they will bail and not take delivery. So I've seen that for the last 4 years now, constantly, is the day before a first day notice. And you're right, always on an FOMC meeting, the day after you also see hit. So you probably have a double decker here. And the reason, but I am quite confident when I tell you that the reason for the hit today had nothing to do with the value of gold or anything like that. The doorknobs did it because of the options expiry. The option expiry was Tuesday, but the actual taking of a contract would be tomorrow. And they want to convince those holders to pitch rather than stand and take delivery. So, and that probably is another reason why the open interest. If you were to study the COMEX over the years, I mean, I've been studying this since the 70s when the COMEX came alive. In a day, when you started rolling from one contract month to the next, the OI generally remained constant, okay? And one would get out of the February and move into April. And the price was the contango that you would pay. And it was usually $2. Now the contango is zero. We're close to backwardation. So when you see a massive contraction of the OI, and I saw that yesterday and today, I mean, it just makes no sense. I mean, and especially when gold was in an uptrend. The last few weeks, gold has been moving quite nicely up.
Right.
And to see these guys not and say, I've had enough. So they basically are playing February and giving up at February and say, that's it, I'm not going on. That's never happened before. And I'm just sending little strange signals and saying, look, it's just, that's never happened before. Silver, on the other hand, is the opposite. I mean, silver, you're seeing the price. See, gold is, you have the open interest at extremely low levels. 376 is really, really low. Okay? And the silver is at a very high OI with a low price. Okay? And it's just opposite. And it's, you're seeing two different markets here. And there's no question that they're manipulating 24/7 on these markets all throughout the day, globe, 24 hours. And the price of silver, the price of gold is being manipulated by these doorknobs.
Given the persistent high level of open interest in silver, is it your opinion, or would you agree with the hypothesis that silver is being more aggressively manipulated because of it being in a tighter market position vis-a-vis gold?
For sure. Oh, look, guys, I mean, there still is central bank gold sitting where they can manipulate, although there's...
Yeah, well, maybe not that much more.
But that's it. Well, that's my contention. I really think that gold is gone. Silver, there isn't any above ground silver. And so your answer is perfectly correct. They're having their trouble. And it's all manipulated. And they seem to control silver at ease. They're controlling it to know, with ease. They're having problems now with gold. Why? Because China is taking they're buying gold and moving it onto their shores. They're moving on to Shanghai, and they're not stopping. And I'm telling you, the key guy to watch for, the guy who is the expert, is Koos Johnson. This boy, he's a Dutch, and he's been analyzing all the stuff going, and the correct to figure Chinese demand. You go to what gold leaves a vault at SGE, the Shanghai Gold Exchange. Gold, once delivery is taken, you cannot keep it there. It must leave. Okay, you're given 3 days and out it goes. So Koos basically measures the gold leaving out of SGE and comes out, and I believe you guys, I think it was 100 tons the last 5 days on average was coming now. It's close, 96. And it's close. Leaving. Yeah. Now, if you take that on a 5-day week, that's 20 tons a day. And 20 tons a day, if you take the amount of gold that the world produces globally by everybody, all the mines, ex-China, ex-Russia, I don't count Russia, I don't count China itself, because all their gold, it keeps to themselves, and they move it onto their official reserves. It's about 2,170 tons of gold. Okay, if you take that as an average on a 5-day week, you got 7 tons a day. Okay, so if all of a sudden you have 20 tons a day going into Shanghai, okay, for their jewelers, their citizens, central banks, but sovereign will probably take some themselves. Regardless, it's triple what the world produces. But then you got Russia is taking its 200,000 ounces of gold. You've got South Korea for the first time buying good quantities of gold. Mexico buying gold. Central banks are buying gold. Okay, and then of course you got your jewelers. The jewelers is 3,000. The demand for jewelers around the world is 3,300 tons. Then you got your mints, and their mints are going crazy. You got my mint, or the Royal Canadian Mint, is now running full tilt. You got your mint, the U.S. Mint, going full tilt. The Perth Mint, Ron is also telling us there's huge demand coming out of Perth. Okay, so every physical market is going crazy. And of course, another way of measuring it is looking at what's going on in Switzerland. These are the biggest refiners in the world. The 4 biggest refiners are now going 24/7. And what they're doing is converting probably good delivery bars into kilo bars. And kilo bars is the bars of choice of the Chinese. These are exactly 32.15 ounces. And of course, that rings a bell to a lot of people. In the last few days, we saw 10 tons each month of gold leave JP Morgan, which is exactly 10.00 tons, which would be up kilobars. And if it's really kilobars that's left, well, that's probably going to the Chinese. So, I mean, these are the things that we have to watch. And then you measure what's going on at the GLD. And of course, the GLD has been declining rapidly in gold up until these last 12 days. And now we haven't seen actually yesterday it rose. Now, it doesn't mean that China did not get its gold. They probably did. The problem is that citizens or investors want gold too. And they're bidding for gold, and all of a sudden the poor guys who are watching over the GLD are now got a real problem on their hands. Because you have demand from bankers who are trying to get gold to China, and they're demanding it. Plus, you have investors saying, I want to get in on gold. So they buy GLD. What they should be doing is really buying physical. Because when you're buying GLD and SOV, you're buying a piece of paper that's probably garbage. But regardless of the matter is, that's why GLD has got a problem. We have to watch it. And SOV, you have not seen any decline whatsoever in SOV in the last month or so. So I'm seeing that's pretty well constant. I think we're at, what, 322 million ounces there. And that's been quite constant for the last few weeks. So that's my take on the COMEX. And then, of course, tonight, the open interest that is standing, so far, we have one more day. Now, even though they have tomorrow's first day notice, and they have to show, but the OI readings are always 1 day back. It gives the house their advantage. So I got one more reading day. But as of tonight, it's 22,230 contracts. During the last day, I see about 8,000 contracts leave. It's a small amount. It's not as big as today. So if we have something like 14 or 13,000 contracts, that'll be 1.3 million ounces. And 1.3 million is, what, close to 36 tons of gold? And I think it's pretty close to that. Can you imagine with a very, very little amount of registered gold? Registered gold is not there. They are going to have a terrible time. I've also noticed...
Speaks to why they were so aggressive this last 24 hours beating gold down.
Yes, that's correct. Well, I'm giving you the figures, guys. This is what it is, and I'm very perplexed by this. That's a very high OI for 1 day to go.
Yeah.
Okay, and this happened again. This happened a year ago. If I remember correctly, it was about the same thing, and all of a sudden we had just a huge amount stand for February. And I'm going to guess another huge quantity. But this time, there's not enough registered gold okay, and the other thing, if you've noticed, if you look at the silver COMEX, you're seeing silver enter into the vaults constantly. You're seeing, 600,000, 500,000 constantly coming in to the dealers. You don't see that in gold. You're not seeing an ounce coming in. In fact, I think there's been one, JP Morgan only took in one contract, one amount. I think it was 7,000 ounces. It's like a small amount. That was the only for the whole year of JP Morgan on the dealer side. Very, very tiny. So the dealer is not bringing in anything. So the gold has to come from leasing or from their customer account. So if they lease it or they hypothecate it or whatever crap these guys do, but gold is not coming in to service what I think needs to be done. And today was a dandy. What happened today? There's about 64,760 ounces are adjusted out of HSBC. Okay, so that goes from the customer side to the dealer side. When I see that, I generally know that I'm going to see in the next few days a settlement out of that. So HSBC account will drop probably more than that. So they needed that, and it's probably higher. So again, the vaults are going to come down in quantity, and that's what we're seeing. We're seeing everywhere. COMEX vaults going on the registered side, the GLD side, and sooner or later you're going to see a default. And we may see a default this February, this coming month. I cannot see them settling all this. If we're getting 30 plus tons standing, I can't see it.
We had the big news yesterday, obviously, of the Fed tapering another 10 billion. We were discussing before the show that Harvey really can't see any further tapering. What's your view, Eric? What's your reaction to the taper announcement yesterday, and whether Yellen will continue the taper, or whether Bernanke's two shots will be all they're able to pull off before they have to reverse course?
The nice thing about the Fed is it's been consistent for the last couple of decades. They always overshoot. Whatever direction they're going, they just screw up and and only turn tail when they have a justification in the market showing the entire world that they overshot. So I believe that, we're going to go down to probably 55 billion total on a monthly rate. So we'll see, one more round of tapering, maybe another round on top of that. That will be dependent on the degree to which markets react. And we're already seeing, around the world, the impacts accelerating in the emerging markets, given the current account deficit statuses that they have and the pressures that are coming when liquidity is being pulled out of the system. So there's that. There's the Fed as the buyer of last resort role that they perform now. That's all important given the fact that China and Saudi Arabia and Russia in particular are curtailing their purchases, and in fact, in China's case, outright stopping more often than not, other than this occasional month of purchases of U.S. bonds just for the sake of show. So Yellen is known as someone who's considered to be more dovish than Bernanke, and she'll be more than happy to flip over. And then on top of everything else, we have the economic signals beginning to roll over. We have the housing market rolling over very clearly now. Some conventional money managers and economists working on Wall Street are looking at the leading economic indicators in the rear view mirror. I know it sounds like a contradiction, but over the last couple of months, they've actually been pointing to the economy moving up, and I think that frankly is a product of the many years of basically just BS mope in our system, where the psychological impact of a rising stock market based 95% on simply just liquidity pump priming and nothing more. It's certainly not driven by earnings. I mean, last 2013 we had the S&P 500 up almost 30%, and earnings were only up 6%, and that's with a weak economy. I mean, and all of this money printing over $1 trillion in the year. I mean, and that's all we can show for it. I mean, it's really quite sad. So, we were talking earlier before we went on air about how it's likely that at some point the Fed will overshoot with their tapering. The markets are going to react. We're going to have some big correction. I mean, I've been basically proffering that forecast for over 2 months now, with the window of, say, March, most likely to June, where the bigger correction, not what we've seen because of the fears in the last week and a half or so of, the China trust default risk factors in the emerging markets laying an egg in the last week or so, when the currency crisis and whatnot. All this is minor compared to what I think will be coming when people begin to come to terms with the fact that tapering is having a massive impact on the economy, and also just the status of bonds and interest rates backing up and so on and so forth. So when that window comes, when the financial assets fall far enough to where the Federal Reserve gods in charge are fearful of their true bosses, the banking system, and the status of their balance sheets, they'll step in and they'll start tapering further, returning to buying more and increasing the amount of assets they purchase. They probably will not increase mortgage-backed securities. To some extent, that mess has already been cleaned up in the balance sheets of banks across the United States, but they certainly will be buying more United States treasuries. And I know Harvey agrees, because we were talking about that before, and he's even thinking,
I'm of the opinion that they actually will stop now. I don't even think they'll get to the 55. I think they're going to stop at 50. The risk to the contagion is so great when you start seeing bank runs in Russia, in the Ukraine, and you saw today massive amounts of investment leaving France, of all places. France. You're seeing
there's a lot of protests there.
Yeah, you're seeing the world is scared, and the tapering, the U.S. buying of bonds and all this printed money, that's where it went. And if you start, saying I'm not going to supply those money to the BRICS countries, Brazil, Russia, India, China, South Africa, if these countries aren't getting it, then they'll contract. And then you got to remember is that what's the big risk is, of course, you got credit default swaps. These American banks have huge credit default swaps, and You know, if these guys fail, I mean, you got, you know, 20, 40 trillion dollars of these default swaps blow up. That'll bring down the banks. And of course, if the interest rates rise, if you see the interest rate, if the 10-year bond rate go over 3%, you're going to see a lot of blow-ups of the U.S. banks as well, the 5 major banks.
And to some extent, the Fed and the Treasury like all of this turmoil because it allows them to buy time with the Treasury market, because people go rushing in short term to the U.S. bond market to park big stashes of cash. And you'll notice that, you know, about 3 weeks ago, when we did sit around that 3% level, all of a sudden the turmoil around the world cranked up, and now the Fed has at least the month window or so where they're relaxing because everyone's afraid of a credit crisis-driven deflationary crash, which was putting all of this money into the bond market on a short-term basis.
That is 100%.
In the long time, we'll have MyRA, and all the
yeah, right.
all the general public will be parking all their cash in a no-risk, guarantee return Treasury bond.
I want my Obama MyRA.
Right? Oh, that was
and my Obama phone.
All right. I feel sorry for you guys down there.
No, well, you can have them if you want them. I mean,
well, that's so cute. You know, buying crazy. You saw today that even Zimbabwe is now no longer going to accept South African rand. Not interesting. Well, all the nations, you know, they will not want Zimbabwe is afraid of the South African rand collapsing.
That's pretty sad.
And actually, that's probably the next nation to go. They're in real problems over there. But I think, guys, the real country to watch for everybody is the Ukraine. And the reason is it has huge current account deficits, but not only that, it's critical in location to both Russia and China, and Putin will protect it. And then its citizens are divided. You have the eastern part of Ukraine they speak only Russian. Actually, the president only speaks Russian. Okay, where you have everybody in the west in Kiev speak Ukrainian. So you see it's ripe for a civil war, but remember it's central for the gas pipelines, which is why Putin needs it, and the oil pipelines heading through Turkey. So that nation is critical, and wars will certainly be fought over this. And generally, what happens when you have a bad economy, wars start. So that's another area that gold will probably benefit very shortly on this. Okay, I don't know if that's your take on this, guys. That's, I'm certainly seeing it,
Yeah, they're almost like the Balkans in the 1914 period. I mean, it's like very easily the kindling for what could engulf into a broader war, unfortunately.
Yeah.
And that's off the radar to some extent compared to what the United States media focuses on. By the way, I'm curious, do you see reports nightly about Ukraine in the Canadian media?
I'm sorry, on what? I didn't catch that. You got garbled.
In the Canadian press, do you see, like on television or broadcasts in general, nightly or daily reports about the Ukraine? Because in the United States, it's relatively quiet.
Oh, no, we see it. Sure. Oh, yeah. But I probably get most of it from, Zero Hedge and things, but it is on our TV. We are seeing it.
Right.
So it's certainly becoming mainstream. In fact, that's basically what's happening a lot, is mainstream are starting to pick up. And they're even
We're too busy covering Justin Bieber's arrest.
Or the Grammys and satanic rituals on TV shows of music industry.
I think he's Canadian, isn't he? Justin Bieber is he a Canadian boy? I think he is. Strange dude, I'll tell you. It's very strange.
Well, everyone in the United States is squawking about exporting him back to you, so you might have him back pretty soon.
Okay. We'll block the borders.
So before we wrap the show up here, guys, obviously keep our eyes on the emerging markets. And again, Harvey is looking for possible big things in February in the COMEX, correct?
Yeah. Oh, I'm watching it like a hawk. I watch daily the movements of gold, what comes in, and I haven't seen any gold going in on the dealer side, and any settlements, if there is settlements. I have my doubts on a lot of these things, is coming from the customer side of things. It's like a loan, a lease, or just a movement. But when
you know something's going on when JP Morgan loses just about 50% of their actual physical gold inventories in under a week.
Yeah, but you got to remember what it was. It was 10 tons and another 10 tons. It was 20 tons of gold in 3 weeks. Okay, and it was exactly 10 tons. And that 10 tons happened to be, could have been kilobars. And by the way, the vault that is JP Morgan's vault is now owned by China. I don't know if you guys know that.
Right.
They own that vault, and that vault is connected to the Fed, the Federal Reserve Bank in New York.
You also have the dynamics of JP Morgan high net worth customers probably yanking their physical because they know the game's up and they want to make sure that they have a seat when the musical chair game stops.
100% correct, but when I see it would be kilobars. See, it was right on. It was a withdrawal from the customer side.
Right.
So, and that is, I mean, I've had many discussions with the CFTC people, and they put a hammer on their table, and they basically say it's physical and there's no such thing as paper. Okay, and I said, okay, but look at this. If it's real, if that 10 tons is real, of course it's kilobars. The West don't use kilobars. When have you guys seen a kilobar? You don't even know what a kilobar. For you use metric. We've seen a bit of it over here in Canada.
We sell a couple of them on SD Bullion, but they don't sell. They don't sell very good. Everybody wants just the ounces and 10-ounce bars.
Okay, try 10,000 bars going into JP Morgan. That's what twice happened. So So it's not here. So the question is, first of all, who made them? It couldn't be made here. I doubt that. Maybe, I don't know, but that's usually it would be Switzerland. It'd be making. Why would somebody make them here? Well, they could. But it just seemed odd. That's all I'm telling you, And so when you say, a customer, but if you had to look at it, was 10 tons. I mean, that's massive. Okay, and by the way, in a year ago, another 10 tons. So in a year, little over a year, 30 tons of kilobars, if you call it kilobars, have moved out of JP Morgan customer accounts. Those are facts. So the answer is, who did they go to, and for what reason?
Jamie Dimon.
Jamie Dimon.
Pride masters.
Biggest crook of them all. Anyway, look, I will keep monitoring this for you guys, and then the month of February is a critical month because there is not, there's only about maybe 12, 13 tons of registered gold.
Yeah, that's just amazing.
Yeah.
I mean, that's over 90% decline in the last 2 years or so. I mean, it's just unbelievable.
Yeah, and now, and what would happen if 34 tons take delivery now?
Yeah.
Okay, where is that going to come from? And remember, not any gold is coming in. So that leaves, it's strange things going on.
And for the casual listener, not somebody who just pays attention to these shows on a day in, day out, week out basis and pays a lot of attention to the precious metals market in general. I mean, the really big picture point, the take-home point is that the massive declines in price and declines in inventories have been going back all the way to April when we had that drive-by shooting of April 12 to 15 and the start of the most aggressive cycle of this management of the gold market and silver market, and the declines in inventory vaults and all the gold that has been flowing eastward exceeds easily 1,000 metric tons of gold, easily, when you take into consideration all these private vaults and GLD and so forth. And that's where the gold has been coming from to satisfy the large amount of demand increase that we've seen, and there's no more ability to replicate that. So that being said, 2014, whether it's February or who knows, is probably going to be the year when everything shakes out because the cartel will no longer have the ability to manage gold because there's a physical limitation. People sometimes just poo-poo this and they think, cartel's all powerful, they can do whatever the heck they want, but there's a law of gravity, to draw an analogy here, and the power of gravity is defined in this instance by the limitation of physical gold availability to satisfy a market that has just not shut down. The gold market, as we've spoken about in this show, is just on fire. It continues to be on fire, and there's no reason for it to slow down, given all the geopolitical and global macro monetary mess that we have. The smart money in Asia and other places where people are able to buy will continue to buy. At some point.
Well, Harvey,
shake everything down.
Make sure you keep us updated, Harvey. Keep a close eye on it in through the last day and a half in January, with the last day's reports tomorrow, and then in through February.
Tomorrow will be very, very big. I'm going to see what I'm going to be doing is watching two things. It's critical. I'm going to see how much tomorrow at 1:30. I get to know how much is standing. Then I'm going to at 3:30. I get to see how much movement come into the COMEX. And if I see no gold coming into COMEX, knowing we have a good delivery month, I mean, they're in a crisis. Because gold has to come in to service these people. I mean, they're standing. Where's it coming from? And those are the kind of things that I'm going to be watching and reporting for you guys, okay?
All right. Well, it's always great to have you back, Harvey. Thanks for joining us once again.
Call me anytime, guys. It is a pleasure talking to you.
All right.
Nice chatting with you.
For the Doc and Eric Dubin and special guest Harvey Organ, thanks for tuning in once again to the SD Weekly Metals and Markets.
The Doc's new investment option.
Lead bullion.
Buy your ammunition from the Doc today at sdbullion.com.